week. Welcome to today's virtual roundtable sponsored by Capital Institutional Services. I'm Marc Viani, Director and Product Manager of the CAPIS platform. Today's topic is solutions for RIAs exploring outsourced trading in whole or in part as it relates to managers, sub-advising wrap and custodial platforms, as well as institutional assets. Before we start, I am required to read a brief disclaimer. So let me get that out of the way so we can get going here. The opinions expressed by the featured speakers are neither those of Capital Institutional Services nor its employees. Any comments and/or information presented within the presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer or invitation or recommendation to sell or a solicitation of an offer to buy any securities that might be mentioned. So now that that's out of the way, I'd like to say we have a very interesting panel today. And I want to begin by having the panel introduce themselves. We're going to start with Matt Krebs, our head of outsourced trading.
Good morning, Mark. Thank you to everyone in attendance. My name is Matt Krebs. I'm the Director of Outsourced Trading at Capital Institutional Services. I've spent the last 15 years in the business in multiple roles. I've been a market maker, position trader, block trader, sales trader, and made my way into outsourced trading and relocated to the Dallas area 3 years ago to assume the role of managing the trading desk here.
Thanks a lot, Matt. Chris, introduce yourself. You're on mute, Chris.
Sorry about that. Thank you, Mark, and thank you to our audience for joining us. I also want to thank Mark and David Krebs for being so gracious to join us and share their observations with us and with all of you. I joined CAPIS in 1992, so next month it'll be 29 years that I have been in relationship management and a sales role here at the firm. And so I'll be talking plenty later, so I'm going to go ahead and give it back to the moderator to introduce our honored guests who have joined us today.
Great, thanks, Chris. David Krebs, let's hear what you're all about.
Good morning, David Krebs. I've been with Signia Capital Management since 2004, served as Chief Compliance Officer and Chief Operations Officer for that entire time. Now I've taken a position on the advisory board for the firm and I'm still very active with the firm, and I pretty much went through the entire progression of trading everything on our own to the full outsourced solution.
Thanks, David. And Mark?
Mark, thank you for having me and hosting. Greetings from beautiful, sunny Colorado. Always beautiful, always sunny, sometimes Colorado. Spent the vast majority of my career and really cut my teeth in this business, oddly enough, at a TAMP, a self-clearing broker-dealer, and TAMP on top of that. And in the spirit of full disclosure, did a lot of business with CAPIS, but really helped to lead the effort and understand all the good, the bad, and the ugly involved in running a self-clearing broker-dealer. And then after Curian wrapped up, spent 3 years at Equus Capital Management, which oddly enough sat on the similar type of platform that Curian sat on top of, albeit with a lot more restrictions in terms of the ability of handling trades and interfacing with the trades. And recently, as of last November, joined a new firm, UX Wealth Partners, also based in Denver, Colorado, as Director of Operations, and effectively starting, the 2021 version of what we believe a TAMP should look like going forward.
Great, thanks, Mark. And I'd like to, just welcome the panelists. Thank you very much for being on here. I know we have a lot to talk about, and there are, many questions and comments. I'm sure we're going to go back and forth with a few controversial issues that are out there. But for today, we're really focusing on the issues that RIAs are encountering as they begin to explore outsourced trading. What are their challenges? Are they aggregating their wrap and institutional and custodial platform orders together? Is this something that they're really looking for when they're looking for an outsourced or supplemental trading beyond what they're doing on their desk now. What are the technical issues? What are the problems? We know David has come across a lot of these, and so is Marc. And we're gonna jump into those, and we're gonna see exactly what they did to solve their problems, and we're gonna look and see what problems still exist that need to be solved, what needs to be accepted out there. So to start this whole thing off, let's go to Matt Krebs, and Matt runs our outsourced trading desk. Matt, why don't you just describe to the audience, how you manage your desk and how it functions, and some of the neat tools that you've designed.
Sure. To begin, I would say a key characteristic of our desk and CAPIS as a whole, for that matter, is the fact that we employ an agency-only model. By that, I mean, we don't take positions, nor do we offer or own any proprietary trading venues. So on the execution front, rather than internalizing flow, our desk is built very much like a buy-side firm. We have access to a list of trusted brokers, virtually every major exchange, and along with that, the industry-leading algorithms, dark pools. So we have an array of venues that we choose from. I would call us venue neutral. Our decisions are based more along where the liquidity is. Our goal for our clients on the execution front is to really leave no footprint, and with that, minimal market impact. I think this kind of agnostic, unconflicted structure is paramount in the outsourced trading world. It mitigates any sort of bias, and it helps to keep client objectives as the primary focus. You're sourcing trades, you're dealing trades where it's in the best interest of best execution. I'd say what makes us most unique and what applies most to today's topic of discussion is the technology we've implemented to seamlessly handle the wrap custodial platform trades in conjunction with the more traditional institutional money order flow. I'm sure many of you know, I've experienced it myself, navigating across a rotation of institutional money in conjunction with wrap, or just solely wrap, where you're on a multitude of platforms. It can be a very arduous process. Historically, we found that the technology is a little archaic, and it's very time consuming. So with that, there's timing risk. You can have variance among portfolio performance, and at times sacrifice alpha just getting yourself through the process and getting through a long rotation. So what we're really excited about is integrating the ARC technology onto our trading desk. It creates a solution that eliminates that rotation through aggregation. We are able to take institutional money along with SMA wrap trades, combine them, execute them at one venue, getting the same price and providing pro rata fills. So for us, our RIA managers and clients we work with, they're able to outsource and aggregate two different asset gathering strategies that typically you're not able to work together. So there's a real value add in the fact that you're now able to streamline something that took a lot of time, can be done with one execution. And on top of that, in addition to that value add, when you're on our desk, you get the other benefits such as our commission wallet, budgeting technology. We're an industry leader in CSA. We offer direct attribution. We have a robust pre-trade, post-trade analysis, and our TCA.
Great. Thanks a lot, Matt. That's a great summation of what you've been able to accomplish on your desk in just a few short years. Chris Hurley, you've been in very close contact with clients and many, many prospects recently and over the years. What are some of the observations and reoccurring themes that you're seeing out there? And if you want to give a little background about, what the genesis of this whole trading away and aggregation, and where did it all come from, and where do we see it going, and where do you see it going from your client perspective? You're on mute again, Chris. Hurley, you're on mute. Unmute yourself.
I'm not very good at this, am I? I'm trying to use the space bar to unmute myself. And anyway, thank you, Mark, for that question. A few large companies that, well, we hear the term outsourced trading a lot, and it means different things to different people. Mostly the recurring theme is companies that are trying to move to outsource the most cumbersome aspects of their trading operation. That usually is the SMA or wrap space, and or it could be one of these broker custodian platforms that you referred to earlier. And as you know, while that AUM contributes to the bottom line of the firm and helps them be large enough to be considered for larger separate account engagements, the process of order creation and trading rotation has always been painfully inefficient. Most of the new engagements we encounter are supplementary in nature, meaning the asset manager has a veteran trader or two who are essential to the investment process. They create the orders, they decide where they're going to be traded, they handle the allocation and the settlement and oversee the settlement process. So they're still very essential to the investment process, but there are some very cumbersome aspects of that if they could use software or an outsourced trading firm, would help them be much more efficient, have much better investment results, and also just make their lives easier. Finally, we see a lot of startups who are deferring the decision to staff their own trading function, as trading desks are very expensive to build and staff. Or sometimes we have firms that have faced performance or revenue headwinds, and they're looking to control cost. So those are the main observations in terms of trends. You had asked me about, trading away specifically, and the short answer is yes. Trading away has increased quite a bit. And there's a few factors driving this trend. I think the first is regulatory guidance. We finally got some clear regulatory guidance on trading away. Managers who have chosen to become options on these broker-sponsored wrap platforms have always struggled with trading, a trading rotation, which the regulators mandated to be fair to all the retail clients whose assets are involved. While managers knew trading wrap as part of a block was always the answer, they weren't sure whether or not it was permissible. So as some of these managers grew their businesses so large, they realized that they couldn't execute their strategies effectively with a rotation. So they started to include trades in a block and ask the executing broker to use the step out mechanism to send the trade over to the clearing entity. The compliance people then at the managers then realized, well, wait a minute, the SEC did say that if we're going to trade as part of a block, all trading costs have to be shared pro rata across all the clients. So that was the SMC letter from 1995 for anyone interested in looking that one up. So they started realizing, well, in order to be in compliance with that guidance, we have to pay the same commission for the wrap clients as we do our regular institutional clients, which led to the problem that the sponsors won't accept a commission. So the only answer was to step out the trade, present the trade to the clearing entity with the commission included in the price. So we had clients back in the mid 2000s that approached us asking us to do that. CAPIS has always been very compliance driven. We're agency only. The idea of doing net transactions where the commission isn't fully disclosed was something that we weren't completely comfortable with, which sent me down the rabbit hole of trying to figure out, well, what other options are there? And looking at the ACT system, which is probably the most popular system that was created by NASDAQ for broker-to-broker trading, and now is owned by FINRA. I found this field on there called the explicit fee field, which was there for broker-to-broker trades where the SEC fee that's charged on sales could be passed along to the broker who is clearing the trade, and in turn passed along to the retail investor. I approached FINRA, NASDAQ back then, and said, well, could we use that field for wrap tradeaways? And at first they didn't know what the heck I was talking about, but once I explained it to them, they said, that's actually a great idea. And they went ahead and expanded the purpose of that field. Problem solved, right? Wrong. Every large clearing participant out there just sort of ignored the fact that you could use that field. And that stayed that way for a long time until recently. We'll get back around to that later in the talk. So the other big regulatory thing was when the SEC decided to audit managers and wrap sponsors. And this was what, Mark, about 5 years ago when this started. Yeah. And it basically what the SEC, where they came down on it was disclosure. The asset manager needs to make sure that in their ADV Part 2, their brochure in Section 12, that you clearly describe your trade-away process, and that you clearly state that commissions will be charged, because these wrap programs were sold traditionally as, hey, there's a management fee, but there's no commissions. When in fact, there were being commissions paid, they just weren't being disclosed. So the SEC's remedy was to say, sponsors, you need to start disclosing, not buried in a 100-page report, but a separate disclosure that you send out to your retail clients and to the advisors who are putting their retail clients into these products, to say, hey, you need to understand that some of these managers will trade away. Here's how often they trade away, and here's typically what they pay. Now, and that gives the retail investor and that advisor to look at the performance of those managers and say, hey, he outperforms, so it's, who cares if he pays a penny a share when he trades away? That's mainly what the SEC was after. I think the other big driver was the fact that there's been so much pressure on explicit commission rates, to the point where I think we forced our brokerage industry into the principal markets, where much more trading cost is hidden than before, when there was more agency trading going on. They realized that, managers have realized that by including the wrap into their block, they know they're not going to run into trouble with the regulators as long as it's adequately disclosed. They're getting better performance, better execution, and it helps performance. And it also expands their commission budget by being able to pay those commissions pro rata, just like the SEC offered guidance on that effect in 1995. So mostly it's been regulatory driven, but also now that managers feel more comfortable, they're starting to trade more and more as part of a block, which is the way it always should have been.
Right. Chris, do you see any increase in the use of middle and back office outsourcing firms by these managers that are looking to trade away and aggregate? Do you find they're going more towards that end because of the extra work it takes?
Yeah, I think most managers are always looking to make their operational processes more efficient and cost less, to control cost. Software has come a long way in helping managers with the middle and back office functions, but there are a number of great companies out there that have been very successful on the middle and back office side of things. But as I mentioned earlier, the trader is still very essential in order creation, order routing, and it's difficult to replace that function completely. So yeah, middle and back office is usually the first place they go, and then they realize, okay, well, if my veteran traders, if somebody has a medical issue, or that just wants to go on a vacation, or we're just really busy, it'd be nice to have a supplemental option to be able to hand a trade over to an experienced guy like Marc Krebs and say, hey, I need you to execute this for me, and not just keep the commission yourself, but I need you to sprinkle this out through the brokers that are providing me research. And that has, I think, become very valuable to in the estimation of a lot of firms that we talk to.
Yeah, and one last question. As we see, these incoming calls from RIAs that are looking to outsource, like we said, some or the whole, all of their trading combined with these aggregated orders. Are you finding that it's more of becoming a requirement for an outsourced desk to have this capability to be able to aggregate these orders, be able to go back to the, do step outs at a net price where the net price is the same as the DVP settlement with the execution price plus commission? Is it more of a requirement now, or is it just starting to grab hold?
Well, I think that if you are a manager that has wrap assets and you're talking to a broker dealer that you're contemplating outsourcing to, you're going to need that broker dealer to be able to take over that process of order creation, of trading rotation, and the things that we all just talked about. And if the broker can't offer that, then I think the amount of benefit that a manager would get from trying to outsource would be greatly diminished. So I think it's specific to a particular client's needs. But yes, if they have assets on the retail platforms or in these wrap platforms, which many of our clients do, then yes, it becomes very important when looking at which firm will supplement their trading operation.
Great. Thanks a lot, Chris. We're going to move along to David Krebs. But before we do, I need to fully disclose that David is a client of CAPIS, and he is in no way related to Matt Krebs. They just share a last name. We're waiting for the blood test results to come in. We will post those on our website shortly. So David, tell us about your firm and what you have done in the past and how that morphed into using some of the tools that we have on our desk.
Well, a lot of the things that Chris just described are the pain points for us. And I started with the firm in 2004. We had about 35 accounts that were all with one wealth advisor in a managed account program. We very rapidly, after I joined them, started adding accounts from wrap program with about 3 other custodians. So within about a year, I was managing 6 different custodian relationships, and it was all those accounts were separate accounts, and they were all directed brokerage. So we had to trade initially with those, they were custodian and brokers. So we progressed, I think, with that up to about 2005, and then we had a sales rep with us that started bringing in institutional business, and that really changed everything for us because suddenly we had to deal with all kinds of new compliance issues like pre-trade, post-trade compliance, and then also all the things that Chris just described about allocating trades and blocking trades and how we were going to handle all those issues. It really became for me mostly a compliance issue initially, because I was looking at it, how am I going to manage this and meet all the requirements for compliance in an organized fashion? And it also meant we had to hire people, which we hadn't had to do before, particularly a trade administrator. So within about 2 years, really rapidly in the first 3 months, but then progressively over a couple of years, we just kept adding people, adding systems. We got the OMS that involved getting servers to handle the databases on site. And as the IT person for the company, I was doing all this work myself. So I was doing all the operations and compliance. And that went through setting up servers for Moxie OMS, that was setting up workstations for Omgeo, which did our allocating at that time, setting up fixed connections to the brokers. There was just a lot of parts and pieces to that whole infrastructure to try to do all that trading internally. And it initially worked really well. But after about 3 or 4 years of dealing with it, we realized that I personally was spending a great deal of my time trying to correct all the errors that happen downstream with those step out and trade allocations. And so even though automated systems would work well, oftentimes on the other end, the party on the other end wasn't receiving it correctly, or there was interruptions in communications. And I just found myself spending a tremendous amount of time cleaning up problems with all these systems. It also meant from an IT standpoint that I was spending a tremendous amount of time maintaining all those systems. So all the servers, the workstations, and all the software had to be updated all the time and managed. It took a lot of my time. The other thing I felt that was an issue when we were in that time period was the communication between the portfolio manager, the trade administrator, and the broker that was actually executing the trade for us. There was a lot of times where that communication was pretty weak, and there was a lot of back and forth between the trade administrator and the portfolio managers, that he wasn't carrying out their instructions as they had really asked him to carry it out. So it was just like there was a middleman between them and the broker, which wasn't really effective. So those, it was just like I say, a tremendous maintenance project to maintain all that. The trader and the benefits we paid to them were probably costing us in the range of $100,000 to $150,000 a year just for that one individual. And as Chris mentioned, whenever he was sick or he had a bad day or whatever the case was, it was on me to back him up. And so I had to be available all the time, even when I was traveling. Many times I was traveling out of the country, and I would have a laptop and a cell phone and using my Verizon wireless connection to resolve trading and allocation issues back in the States. And I went through 3 or 4 trips where, it really became evident that our system was always dependent on me. And that was just not a good business way to run our business, to have everything dependent on one person, especially when I was traveling out of the country and things of that nature. So all those things kind of came to a head, and where we just said, this doesn't make sense for us anymore. We're spending way too much time managing trading and not managing our business. And there's just got to be a better way to do it. So we spent a lot of time researching. I talked to several firms. What I found pretty quickly was that CAPIS was the most willing to work with us and not asking and demanding us to change our systems, that they were willing to work with the systems we had in place. Several other firms I talked to wanted us to convert all of our order management system to their proprietary systems. There was just a lot of hurdles in dealing with several of the other companies that I just wasn't willing to jump over. So ultimately, we decided to work with CAPIS, and it's just been a great relationship ever since. And what it's meant is I'm no longer the backstop to all the trading. And we have great communication between our portfolio manager and Matt on trading. They're very pleased with that. It's eliminated that middleman trade administrator in our firm. And it's probably saved us, as I said, like in the tune of $150,000 to $200,000 a year in overhead cost in maintaining all those systems and the trader. So we're very happy with it. I think it's been probably 3 or more years now, and it's going very smoothly for us.
Great. Thanks, David. I have a question for you about, because I know you have some of your clients' money on at least one custodial platform. And I know early on we had talked about, trading away from that particular platform. And the one, issue was, well, you have to go back to that platform and ask them, is there a trade away penalty? How do I process a trade away? And for that trade away penalty, if there is one, can you waive that penalty for me? What was your experience in going back to that particular, without naming names, that particular platform? What was your experience when you did approach them? Because a lot of our prospects and clients all have that same question. How do I do this?
Well, and with the particular custodian, they introduced it as a new fee after we'd already pretty much been allocating to them as trade away. And then all of a sudden they just sent out a notice that said it's all of a sudden it's going to be $25 per trade. Well, that was going to be a huge hit to our firm, and particularly because, or I should say to our clients in particularly, because we trade in micro cap and small cap, and we have a lot of, it might take 2 weeks and a lot of small trades to get to the target weight we're trying to get to. So they would have incurred a lot of fees. And so really, I just called up our sales representative with that firm and explained the situation, and they just said they'd be happy to waive it. I mean, they really didn't give me much of an argument at all. And I think it was because they could see the nature of our trading and that it was really going to impact their clients. I mean, this was their clients as well as our clients. So that was pretty easy to get past, actually. It probably took 3 months to communicate with them, but the actual conversation was actually fairly straightforward, and they were pretty compliant and helpful with it. So that's how I ended up.
And that's interesting that you didn't really have much of an issue getting it changed. Maybe because of the nature of what you're managing. And we, quite honestly, we hear, oh, we're getting pushback. They won't change the rate. They won't. So, and these are from prospects and clients. And it's odd that, or it's actually a very good thing that your experience was very good. It actually worked out. You explained your position. This is what we need, and this is why. And I'm wondering if some of our prospects and clients, when they go in, are they demanding the penalty be waived, or are they asking? I think it all depends on how you present your case, and hopefully, we'll talk a little bit more about trade away penalties when we talk to Marc, because he's in the thick of the custodial platform business as well. So, but I find that very interesting that you actually had a very good outcome, even though it might have taken a few months. You got the outcome that you needed, and now your clients are all on a level playing field, especially with small and micro cap. I mean, we all know how that is to attempt to trade 2 weeks of volume, unless you block those items up. But David, thank you very much. And let's move on to Marc Van Rijssen, who has probably a similar issues to what David has been experiencing. But Marc, why don't you go ahead and tell us a little bit about the turnkey asset management platform you're working for now, and your experience working with them before.
Yeah, for sure. It's an interesting evolution, and not the least of which is we've launched our UX Wealth Partners in the midst of a pandemic. So we're actually probably never going to have an office, because this works well for us. But the evolution, the reason that we started the firm was we've got a few commonly owned research entities. And for years, we were delivering research to independent RIAs, and they were using that research at their respective custodian to create models. Eventually, that resonated really well, but the nature of the models that are derived by virtue of the research, it's highly adaptive asset allocation. It's not esoteric names, it's ETFs, but it requires an IAR or rep their full attention during the day. And if they're not fully staffed to have somebody be on the receiving end and then implement, all of a sudden what's happening for a lot of these smaller firms, and our target is 20 to $50 million RIAs, all of a sudden they're spending time in front of the screen again, and they're not spending time with their clients. And that's what we want to support in their business in terms of helping grow their book, as they're spending time with clients. So the question naturally arose, can you do this for me? You have these trade signals. You can create models from those trade signals. Can you just do that implementation for me? And that's where UX was born. So we didn't launch with a custodian in mind, a preferred custodian. We actually effectively backed into being a multi-custodial outsourced trading desk. And that was with zero AUM, or AUA, I should say, in June of last year, and that AUA quickly transitioned. And it started with spreadsheets, and which is normal, and it's not bad, and Excel is super powerful, but it also required my head of trading to work in 3 different custodial platforms, right? So when that became too much, and it's, again, to David's point, is we could have a specialist at each custodian, a trader that's a UX trader working at each custodian, but that's not cost effective and it's not a good use of anybody's time. We may be trading very actively for a number of days in a row, and then we may be silent. So we want to be mindful of that cost. The immediate solution, the reason for my hire was I have a mind for thinking about how to, take a complex problem and articulate it in a simple way. Was, well, we don't need to be in 3 different platforms. We need to be in one platform, one piece of software. So I started flipping over a lot of the fintech stones that are out there, and probably spent the last 4 months doing so. And we arrived at a good solution. And Marc, you're instrumental in helping us kind of uncover some of that. But then what that is going to allow us to do and allows us to do is, again, work in one system, but we're still trading blocks at each custodial's trading desk, right? And that's not the unicorn we're after. I'm after more of what David's described, which is I want to be able to trade my model and those signals in one block across the entire book, across all the custodial relationships that our RIA partners have. And again, it's not that it's a liquidity issue; it's just a mechanics issue. And we're getting when we ask the question, it's a simple question to ask. Why not just block up your child blocks at each custodian into a parent block and execute the parent block, which, wherever the liquidity is. And if you are a student of ETFs, you know how that liquidity is derived. You understand premium discount. I mean, we have the chops and the acumen to want to do that. But the pushback on the RIA custodian side is they don't want to give it up. Frankly, because we trade often, I should say, right? And we trade in some decent size. So in this model today, where there's incentive to capture those orders and route those orders where you're going to get paid for those orders, why would you want to give that up? And the challenge for me is they offer a mechanism through trade away, through step outs, but it's so onerous in terms of cost that whatever the prevailing market conditions are that's written into the best X disclosure ultimately keeps me from aggregating all those child blocks into a parent block. I just can't make it work money wise. So my alpha is restricted to the best that I can do, and we can do a really good job at the custodian and give them really a lot of direction. But we're also doing rotation now, right? So when you're doing rotation across 3 custodians, it's not going to take a genius to figure out where you are the custodian and kind of the amount of time, which ultimately leads to slippage. Where if, okay, I see that's not UX per se, but if one of the RIA custodians is trading size in some ETF, it's not a foregone conclusion that within the next 20 or 40 minutes, there's going to be another block of that same ETF coming to market. And if it's all going to the same AP, not suggesting that the APs would do anything untoward, but you can certainly get yourself in shape, and ultimately that's gonna impact price. So we know that from a trading internal mechanics standpoint, and then apologies for a lot of the jargon. I think to bring it back to the experience for the RIA and their clients, it's ultimately just an issue of optics. And most RIAs are custodied at a custodian. Some RIAs are custodied at more than one custodian. If that RIA has clients subscribed to the exact same model, and we know that that model signaled a trade today, but they see 2 different execution prices without understanding all of the hurdles that we have to jump through as traders, the question naturally is, why is there 2 different execution prices? And that's the problem that we want to solve for.
Right. And you bring up, the whole ETF trading and execution. And I have a lot of experience on that end of the business, having to have managed a group many, many years ago. So I know how orders come in. I see, you would see who the client is, and you would know which way they were, even if they asked for a 2-sided market. So, in a perfect world, wouldn't it be here's a leading question for you, but wouldn't it be better for you to be able to take that aggregated order over 3 custodial platforms and go out to multiple ETF approved participants and put them in competition with each other and say, you're in competition, make me a 2-sided market. You have 2 days of volume. That's really probably the only way to trade this particular name. Wouldn't it be better if the custodians would just say, okay, yes, that's a better process for our clients. They'll get better performance. Isn't that where we all want to head? Isn't that where we all want to go? And I know I'm like answering your question for you, and I'm leading.
No, the answer is, of course, and at the very least, we want to be able to even know what those 2-sided markets are in aggregate. And maybe that's even a step towards, leaning in that direction of, hey, let me, I don't know how you do it in real time, because in real time we have to trade, but we certainly put that on, on paper and say, hey, listen, at this time, my child blocks were, X and my parent block would be Y. What would it look like? Do that cost benefit analysis of the 2-sided market, and we have a pretty good idea of what any pair trade 2-sided market would be at the time. But what would why not get me there? I mean, we are all in the business of serving clients, and our clients are the clients of the RIA. And they're not our clients. Our clients of the RIA in turn is their client. They're custodied at the custodian. We all have the same interest in mind. Everybody should be able to make money in this business. It's just you need to make money from revenue streams that you didn't intend necessarily to make money from.
Right, and that brings us to the 800-pound gorilla in the room, which is, the question is, why are these custodians so resistant to they're not saying you can't trade away, they're just making it prohibitive with trade away penalties. What could it be? What is that reason? Why do you want to hold this order flow? I mean, I think we all know. Marc, if you want to expand on that a little bit.
Yeah, I mean, I think it's in the news recently, right? As recently as last week. And payment for order flow is not a bad thing, but when payment for order flow is driving your revenue model, on top of asset-based pricing, on top of cost prohibitive trade away and step out fees, on top of the other 800-pound gorilla in the room, which is cash on deposit. It's not making a lot of money now, but it stands to make a lot of money in the future. You have to decide what business you're in. Are you a bank that's offering brokerage services, or are you a custodian? So yeah, that's and I think it just takes a good look in the mirror, and maybe some legislation. And it's not suggest that, and this is my, this is where I feel strongly. Just because we have the ability, if we were to have the ability to trade away without it being cost prohibitive, doesn't mean I'm going to trade away every single time. There's still going to be money to be made. There's still going to be opportunity for payment for order flow. And matter of fact, we're kind of conceiving what does that look like as we evolve from an RIA standpoint, using all of these rebalancing tools. Is some of it should just go to the custodian. If we can determine that up to a certain block, small block, 1,000 shares, 2,000 shares across however many clients, that's great custodial order, AutoX, get paid on that stuff. If it smells and looks like retail, it's probably retail. For the bigger, chunkier stuff, at least give me the opportunity, again, without it being cost prohibitive, so I can go seek out, I don't want to go directly to the AP. Why? There's so many middle people in between these trades. Or I want to go to you. I just want the flexibility to go maybe soft dollar something. But today it's cost prohibitive. And it's cost prohibitive, I'll just add this, maybe it's not cost prohibitive for your 7-figure client, but I'm aggregating my 7-figure client with my 5-figure client, So those smaller trades incur the same penalty to trade away as do the bigger trades. So therefore I can't make it work.
Right. And I think what we're all talking about here is not really, does the wrap sponsor or does the custodial platform not have the tools to execute? They clearly all have the tools. but it's more it's the process for the investment advisor, for the TAMP, for the RIA to be able to aggregate these orders and trade them as a block, because just inherent in rotation itself, it just becomes the timing risk. There's always leakage, and leakage not in the sense that someone is telling the world about your order. There are electronic computer systems that will pick up that you have this rotation. They will figure it out. Blocks are trading here over time. They stop. Oh, they start again. They stop. They start again. So the high frequency systems out there, they see this. They know what's going on before we even know. So to avoid some of the pitfalls, that are out there, the best way is to curtail that rotation as best you can. And I think we're seeing that, throughout the industry. We're getting a lot of phone calls on it, and there's always been interest. But then again, there's always the pushback. There's always the excuse, well, I really can't, or I don't know how. So it's very, it's very, very difficult in the industry right now. But I think that, with the advent of the 800-pound gorilla in the room, like we're talked about, things are coming to the surface now. And I really think that the custodians will take a step back and say, okay, we're going to have to ease up on this a little bit because of everything that's out there right now, of everything in the press, all the scrutiny that they're under, brokers and everyone else. So let's take a step back. The most important thing is that mom and pop get the best price they can get, net of any commissions, fees, and whatnot. And I think that's really, what we're all striving for. And in the end, look, the tools are there. It's just the acceptance on the RIA side to go out and ask, can I do this? If so, how much? Can we negotiate this penalty to zero or something that makes sense? I'm kind of summarizing everything we're talking about.
I think one thing worth mentioning in that negotiation with that custodian was that we did transfer all our accounts from the program they were under, which was a per ticket charge arrangement, where they always had a per ticket charge, and then they were going to add that step out charge on top of the per ticket charge. We changed all those accounts to asset-based custodial fee. And when we made that change, that's when they were willing to drop the other fee for the trade away. So I thought that was worth mentioning if they're working with those custodians, that they might go to that direction. I think the custodian felt since they were getting a fixed amount off the asset-based fee, they could give up that per trade ticket trade away fee.
Absolutely. That's of huge importance, David. And, I think that what this comes down to is an educational process for both sides, talking to the sponsors and trying to quantify, okay, we're not going to, as Marc mentioned, we're not going to trade away everything. If it's a cash flow trade, you're going to get your payment. But when we're making a major move in an illiquid name, how would you handle that order, and how much revenue are you foregoing if we trade that away? Number one. Number two, how can we make that up in some other way, like a custody based arrangement instead of a per ticket based arrangement? They went to zero commissions voluntarily, so obviously they're willing to forego the $5 or whatever they used to collect. And if payment for order flow is really not that significant, then maybe the pushback isn't that much. More importantly, the clients need to understand, the advisors and the clients need to understand that we're talking about basis points of return here. It's not significant in the grand scheme of things. And whereas the market impact and trading cost of having to use a rotation or trading, giving a high ADV, very difficult order to a desk that's not prepared to handle it can far exceed the amount of cost of 2 cent commission or something like that. So
yeah, the biggest,
it's easy to talk about, well, hard to talk about, but also hard to prove from a quantity standpoint. And that's sort of the challenge.
I think one of the biggest challenges we had with the rotation beyond the, the mechanics and the different pricing and all that was the fact that we would have an institutional account that would need to purchase 1 million shares, and then we'd have in this rotation the wrap accounts or managed separate accounts that would maybe need 10,000 shares. We'd place the order with that custodian or broker, and then it would sit there and it wouldn't execute. And we'd be calling them and talking to them and wouldn't execute. And we'd have these huge blocks waiting in rotation for these little piddly trades for these small accounts. And some of the relationships we had, they maybe only had 2 or 3 accounts that were, $150,000, $250,000 accounts. They were very small accounts, but those relationships were important to us. They were local advisors that we had personal relationships with, and so we wanted to maintain them. But that was a real challenge for us, and that was a big one that was eliminated by blocking everything together.
Great. So does anyone on the panel have any other comments to make before we wrap this up?
No, my comment is just related to what Chris and David said. Is we've had those conversations as well, and with your direction, Mark, is ask the question: can you guys waive this? I think the answer eventually will have to be yes, as more of these types of roundtables and more of these conversations become well known and we educate folks. But in the meantime, I just got to grind them down. In the same way that persistence paid off for CAPIS in those years ago that where you guys were cold calling me from the sell side to the buy side. I'm going to have to lean on that same level of persistence to grind down somebody at the RIA custodian and understand that what the worst case truly is. Listen, I'm going to take my business somewhere else where I can go trade away. But in the meantime, we'll continue to have those conversations, and we'll continue to have these conversations.
Great. So I'd like to thank everyone on the panel for participating today. This has been excellent. A lot of great information out there. I know the audience, if they have any questions that weren't answered, please give any of us a call here. We're easy to get in touch with. So hopefully we'll have a few more of these over the course of the year, and we'll come up with some more solutions and probably more problems too, because we always uncover those. So anyway, have a great day, and thank you for listening and watching our virtual roundtable. Have a good day.
Thanks, everybody. Thanks, Mark. Thanks, CAPIS.
Thank you, guys.
Thank you.
Thanks.